A mixed picture on the markets. Chris Gilmour from Absa Investments joins us now to just unpack what's going on the global markets and locally. Chris, thank you very much for coming through. We've seen a bit of a rebound in the euro, but it's still quite weak. Lots of concerns about the debt issues, and now Greece is retaliating after taking the flak and saying that it's going to go after the debt vigilantes.
It's a little bit messy, isn't it? Yeah, you know, we've got this funny situation where a week ago we turned on the TV and we saw that the Eurozone authorities are going to be pumping in $1 trillion, that's a huge figure, to try and make life a lot easier for Greece and Spain and Portugal and any other country and company that gets into trouble. But now we've got the harsh realization that that may not actually be, it's not a case of it may not be enough. It may be the wrong medicine. It's a continuation of what we had in the TARP program in the US, throwing money at the situation. It's not attacking the basic problem.
Just let's chip away at it in small blocks. The issue is that you need to curb excessive government spending and excessive government debt in order to fuel that spending, and hence the austerity measures. But you're not going to have consummate growth in the midst of these austerity measures. Everybody just expects it to be primary growth and not the kinds of levels that you need to really engineer a recovery in Greece and for that matter even in the smaller countries within the region. So how do you handle the situation where the IMF, by virtue of the conditions, the EU, by virtue of the conditions attached to the bailout package, have attached these very stringent austerity measures, but you don't have anything to really stimulate growth?
And therein lies the problem. In fact, you're not going to get growth. And the danger is that you have countries like Greece, like Spain, like Portugal, and maybe some others, actually going into what people call a double dip recession. In other words, they just got out of recession into recovery, and whoops, all of a sudden they're going to go back into it again. I think what we're really looking at here is we've had 2 or maybe even 3 decades of very strong consumer-led growth. The consumer has been advanced money by the banks. We've now had a credit crunch. The consumers passed the buck to the banks. The banks in turn have passed the buck in many instances to government. And government is now saying, hold on guys, consumer got to pay. And the consumer's going to have to pay in the form of incredibly tight austerity measures, and they could last for years and years and years. If you take Greece, for example, I cannot see that country, which in my opinion is reverting to being a bit of a basket case now, as getting out of its very parlous situation in less than about 5 years.
What's going to happen to global banks? We saw yesterday on the JSE financials not doing particularly well, and that's really the picture internationally, especially banks that have a lot of European exposure. What's going to happen to them in the midst of this crisis?
Well, you know, as you say, a lot of them do have exposure to Greece and other countries, and the concern is that excuse me, even with this package that was announced last week, some of them could be in trouble if one or other of these countries defaults. That's the first point. Secondly, you've got people like Vince Cable, the Lib Dem chappie in the UK, who's now been put in charge of, guess what, banks. And one of his biggest thrusts in the UK general election was he actually wants to break them up. Look at the US. Barack Obama wants to go back to a situation that existed prior to 1999 with what was called the Glass-Steagall Act from 1933. He wants to break the banks up. He wants to break up their power, to make banks so they can never have a situation where they're too big to fail. And I think that is what's worrying a lot of investors around the world. They're seeing a situation where banks in recent years have made an awful lot of money and going into territories that they didn't go into prior to 1999. And if you reverse all of that, it's possible that a lot of those super profits that were made could vanish.
Let's just bring this back home, because we're already seeing the rand trading somewhere within the 7.7 range, and apparently we're going to see it between 7.4 to 7.8 within the coming weeks as we watch the situation there. The future outlook is that the euro and the pound, in terms of their trade weighting against the rand, will be 50%. We're going to see the euro going back to parity and weakening with regards to the US dollar. For South African exporters into the EU zone, and the fact that the rand tracks the euro very strongly, what can we expect? Because certainly if this crisis persists, we're not going to be allowed to or able to get as many goods into the European market, and that's going to have a direct consequence for this economy, but also for the currency.
If you look at the manufacturing figures that came out last week, In fact, manufacturing has held up surprisingly well in the face of a strong rand. But you're right. I think the likelihood is that the euro will probably continue to weaken. I don't know if it's going to go to parity against the dollar, but it's probably going to go through 120. And if you'd asked most observers, even a few weeks ago, would the euro dollar go to 120 or below, they would have laughed at you. So that's going to happen. I think the pound will probably go lower because, like Greece, they're going to have to implement some really tough austerity measures. And as George Osborne, the Chancellor, yesterday announced to the media, he's found some nasty skeletons in the cupboard. So, you know, it's a pretty messy situation. The rand, I think you're right, will stay relatively strong, which will inhibit the ability of a lot of exporters to export productively at those levels. And the other problem, of course, is as demand declines in the Eurozone because of the kind of issues we've been talking about, they're going to be demanding fewer of our products.
Okay, platinum producers did their outlook for 2010. Surplus platinum in the market because not a lot of it was used last year given the recessionary conditions and the troubles within the automotive and auto sector. Platinum demand for auto manufacturing had weakened to 11.9% in the last year, but people expect things to be a lot better this year.
So much depends on what happens to the US economy particularly. Chinese economy, now China has now overtaken the US as the largest producer of autos. So it's critically important that the US economy now carries on and sustains its recovery, which will mean that there'll be further demand for platinum products. As you rightly say, we're in a bit of surplus situation. But I think they're seeing through that. They're seeing a situation where both China and the US promote the greater demand of platinum catalysts, which account for about 50% of the platinum market. So intimately linked to that, I think 2011 and beyond, it's looking an awful lot better for the platinum producers.
If mining supplies had dropped by 0.3% in the last year, obviously because of global conditions, then it raises the question of what happened to those proposed platinum ETFs, where if people were not going to buy into the mining stock, at least they could buy into the metal, where the prices at least have been buoyed somewhat.
Look, the nice thing about buying an ETF is that you don't buy into all the trouble and strife that goes along with a mining operation. You don't have to buy into the safety concerns, you don't have to buy into the other regulatory issues. You purely buy the metal. And there are a number of ETFs you can buy into, and it has an attraction. Same with gold. There are a couple of gold ETFs around that you can buy into. And again, you neatly avoid getting into all of those problems. What you don't get, however, is a dividend. So that when, for example, you don't get that gearing to the platinum price or to the gold price. All
right, let's look at results locally that were released. The JD Group. The retailer JD Group reported diluted headline earnings per share of 139.2 cents for the last 6 months. What do you make of that?
Went to the presentation yesterday, and I have to confess it was very, very upbeat. Having said that, I've rarely been to a JD presentation that wasn't upbeat. But no, I think genuinely they may well have turned the corner this time. It's been a long time coming, and David Sussman has been a very, very keen observer of the economic cycle. This time around, I think he's probably got it right, and particularly if you go into the financial services line, which was the star performer within the group, it's nowhere near what it could be. 3 years ago, he took me through where he wanted to be, and this is now the fruition of his dream. I think by gearing up that business from the current 2 times level to maybe 4 or 5 or 6 or 7 times, you could see a phenomenal growth out of financial services. But I must caution that will take a much more buoyant economy for that to be allowed to work. But I think all of the things are in place for JD to maintain its turnaround.
I mean, they are quite optimistic about the World Cup and what it means. They were just giving a figure, for instance, that in a month they sell 15,000 plasma screens purely because of the World Cup. But you do have other exogenous factors, for instance, such as the debt to household income ratio and the fact that people are servicing their debt, not necessarily going out there to buy furniture, despite the interest rates being a lot lower. Yeah,
it's very worrying. I mean, here we are at household debt to disposable income of close to 80%. It's not quite at a record, but it's thereabouts. And as well as that, you have debt servicing costs, which in relation to other countries are relatively high because our interest rates haven't come down that much. Pardon me. So the physical cost of servicing that debt every month is, in many instances, prohibitive. So unless and until that changes, and that could be quite some time, that again requires a buoyant economy, a lot of these guys could be under pressure. So I think JD has learned to adapt to those exogenous variables you're talking about, and is looking an awful lot better for the longer term.
I know you love telecoms, and we also got some results coming out of Vodacom. They've seen data growth contribute to their revenues 33%, and they've reported an increase in headline earnings per share of 22.3% to now come up to 510 cents per share. So it's looking good for Vodacom.
Yeah, that was a surprisingly good result. I think most attention in the telecom sector in recent times has been centered on MTN because of their growth into Africa. And Vodacom is regarded as being the kind of the ugly duckling of the sector. But this, as you say, was good. Data was very good. On the negative side, we saw on the prepaid front, they lost about 1.9 million subscribers, mainly because of the RICA legislation that came out.
Right.
A lot of subscribers haven't been able to fulfill all the requirements because they don't have a recognized abode. They're getting around that by saying to a lot of people, well, you know, if you live in a township and you haven't actually got a physical address for us, give us the nearest church hall or church or whatever like that, and we'll accept that type of thing. So I think that'll happen. But as we move forward 6 months or a year, that will be, I think, largely out of the equation.
But we continue to ask this question, what is Vodacom's strategy now? They are the leading player in South Africa, which is already a saturated market, but they're struggling to gain a foothold into the rest of Africa. What do they need to do? Because for MTN, that's the revenue earner. For a company like Vodacom, that is a potential new and growth market.
I think you're right. For both MTN and Vodacom, I mean, MTN, far greater penetration of the continent, but even there, it's getting difficult to see what new territories they can get into and where they can increase the penetration in those existing territories. Vodacom, far more acute, only in 5 or 6 countries. So, look, having said that, as another commentator who comes on here regularly, Paul Theron, says, you know, you mustn't get blinded by the short-term aspects that are currently affecting these companies. There is so much to come out of both of them in the future, and particularly once we have access to high-speed data services. We've already got the CCOM cable, we're getting WACS coming in next year. Once we get more and more of that, they'll be able to offer the consumer a lot more. Tie that into a turnaround in the economy, and then, you know, only your mind limits what these guys can do.